Hey guys, welcome to the very first episode of Real Time Advice. So, this is a new series where I'm going to share real life examples of conversations I've had with clients with issues, concerns that I've actually had in real life. So, hopefully, these become relatable to you. They might be a little bit specific, but they'll definitely be more meaningful and impactful for the people that this relates to. So, in today's lesson, we're talking about somebody considering taking retirement allocation. So, retirement allocation is typically for government employees, sometimes nurses in the healthcare department, and it's basically a multiple of their hourly wages for X amount of months, weeks, or years. And it's a lump sum. It's kind of like a lump sum, here you go payment, which is taxable. So, with it being taxable and someone like, for example, a registered nurse making good money while they're working, there's all these ifs and buts, and most people want to feel good that they're making the best decision for themselves. So, seeking advice and, wrapping your head around it properly goes a long way. So, in this case, when it comes to retirement allocations, there is more to consider than just the numbers. Most people approach something like this thinking the numbers are going to give them their answer. But as you'll see as I dive into this, there's a lot more at play than just calculating, is it better to take it now, to take it later? How is it going to work into my retirement? How much am I going to benefit from this amount, etc. There's more nuances and more things at play, and generally the numbers don't make the decision for the person. Just like when to take your Canada pension plan is very little, usually doesn't depend on the amounts you're expecting to get. Just like most people's decision to retire isn't just about the numbers. The numbers are a big piece of it. They have to make sense, but they generally are secondary to the person's approach, their view, and how they see things, as well as other aspects that I'm going to cover in the lesson. So, if you're ready to jump into retirement allocations or taxable lump sums and how we can address those, stay tuned and we'll jump right in. Okay, so when it comes to talking about lump sums, whether it's leaving a job where you have a pension, whether it's in this case a retirement allocation, a severance, or anything like that, most people come to someone like me and they're looking for answers. They're looking for somebody to run the math and to compare options for them. All right. But one of the first things I'll tell everybody who walks into my office is, all right, we will cover that and I can do all the math for you. But first, we need to be clear on what it is you're doing, what you're looking to accomplish, and what does it mean to do one thing as opposed to another. All right. So in this case, when you're talking about lump sums, taxable lump sums, and pensions or government benefits, in this case, when it comes to a retirement allocation, the main thing that you want to consider is the flexibility. So the number one thing that you get when you take control or ownership, or invest. So once you accept the offer and bring it into the fold of your portfolio or your financial picture, basically you take them up on their offer, you accept whatever package or number that's in front of you. And then you obviously have to deal with the tax and the numbers and all that stuff. But the first thing you need to consider when it's, leaving your pension with your employer, taking it out and putting into an RRSP or a LIRA and all those other things, it's what are your options and what is the downfall? What other things should you consider other than the math of how much will this grow to and how much will I be able to live off of and all those questions that are very legit. But when it comes to pensions and retirement allocations, you need to consider first and foremost what happens once, if you leave it there, you don't have control. So the first first and most important thing is control. If you leave it in a bigger organization and you are leaving this job, or there's unions controlling the outcomes of something, like it is in this case, you want to consider control. If, like, can you lose this? Is there a scenario where, for example, you die prematurely, or you retire early, or you get disabled? What happens to it then? Right? What's your worst case scenario? And are you cool with that worst case scenario? After that, you obviously have to consider the taxation, your situation, your need for the money, and all that stuff. But you need to consider, are you cool? Do you trust leaving it there? Do you trust what's going to happen? Do you trust the longevity? In this case, it's like it was comparing, while it's at my hourly rate today, calculated based on my hourly rate today, but I'm expecting a raise, or I expect my income to increase. Therefore, my lump sum will be bigger in the next couple of years. Sure, but is that guaranteed? Right? Just like investing it and putting it in your RSP, sure, maybe we can expect 5% rate of return, but it's not guaranteed. You could have a negative 20 year as soon as you put it in your first year. But generally, if we're expecting 5%, is your income going to grow by 5%? Is it not? Etc. All right. So when it comes to retirement allowances, that's pretty much the big key thing is, what are the options? What's the worst case scenario? What risks are you taking it by leaving it there, as opposed to bringing it into your fold, under your control and your supervision, and then having control on how it's invested. And if something were to happen to you, if you left your job, if you did die prematurely, it goes to your beneficiaries. You control, you get to name your beneficiaries. It's yours after you've taken it, right? So that's kind of the big thing that usually makes the decision for these people. Now, because this is taxable, the first thing we're going to jump into here, the first illustration that I'm going to use to explain this decision and how it all works, is what I call the pre-tax, after-tax money illustration. All right. Okay, so the first concept we're going to jump into is what I call the pre-tax versus after-tax money. I usually use this to illustrate the difference between RSPs and TFSAs. And essentially, the concept is this. There is two types of money that exist. There's pre-tax money and after-tax money, right? Money that hasn't been taxed yet and money that has been taxed, personally at least. And there's, for somebody who's has a simple situation, they're an employee, they collect the T4 and that's it. There's pretty much four places where your money can be. There's your income, right? There's your pension and RSPs. Both of these are pre-tax. They're money that have not been taxed yet. And then there's money that, you've been paid and taxed on, like after your paycheck, your net pay, which is in your bank account. And then there's the TFSA, which is another kind of retirement accumulation account, but it's on the after-tax side. You put after-tax money into your TFSA, and then it grows tax-free. In the middle here, you have what I call the tax filter, and it's basically something that generally takes away tax when you're crossing over from money that hasn't been taxed, and that money that is after tax that has been taxed. But sometimes when you take money from your own bank account, for example, and you throw it back across the filter, you get that money back. You get that tax money back. And most importantly, in this case, because this is taxable as income, this lump sum is taxable just like income would be. What you can do is similar to like a group retirement or a pension plan. Money that goes straight from your income straight into these pre-tax plans generally never get taxed until they cross the line, until they cross the fence again at a later time, but you get to control when that will be. So for example, with a retirement allowance or a lump sum or a bonus, sometimes there's the option with particular forms or elections that you can send and say, listen, I don't want to get taxed on this right now. I have enough RRSP contribution room. That is huge. I can put this in RRSP. Here's the RRSP where it's going. I'm going to put it there, and I don't want to really be taxed on it this year. So there's basically no taxable event in that situation. And for example, if your taxable benefit, so if your lump sum, your retirement allowance is like $50,000, the whole $50,000 can go into your RSP and gets invested and earns income. If you fail to plan and you fail to get proper advice and know this, you will basically get taxed on the whole 50. Maybe you pay up to 40% tax. So all of a sudden that 50,000 ends up 30,000 in your bank account because you've had to pay 20,000 in tax up front usually. Sure, you can take that 30,000 and put it back in the RSP, but you're only going to get a tax receipt, a tax deduction from the 30. And then you're only going to be investing 30 because the 20 that you've paid to CRA is already gone. You'll get your tax deduction back from having put it in the RSP, but still there's an inefficiency of being only able to contribute 30 into the RSP, and then and then you could put the 30 in your TFSA, but you get no deduction, no tax break for that. You're not deferring tax. And then, of course, your 30 can grow. And then if your 30 goes to 50 again in 10 years or whatever, you can take the 50 and it's all tax free. But that's very important to acknowledge that where's your money going to be, pre-tax or after tax, and where do you need it to be? And where you need it to be and how it fits together, I'll show you in the next illustration. So this illustration I called, it's part of my accumulation framework, and I call it the cascade of accumulation. And the reason for that is pretty obvious. It kind of, as you can see by the arrow, they're all a series of buckets and they're all lined up, kind of stacked one on top of the other, and money kind of all flows to this bottom, which is the biggest of the three buckets, which is saving for retirement, basically replacing your income for 10, 20, 30 years time. It's a big number. It's a big bucket to fill. So usually when we're talking about retirement allowances, people want to keep it in the retirement lane, or at the very least, they want it for more long-term accumulation, right? So in this setup, there's three buckets. The first one is more like a cash flow, like short-term needs, and you keep that in cash. It's not really for accumulation. You're kind of accumulating, but for short-term needs. I'm traveling to Mexico next year. I need to save cash in order to do that, right? You can just keep that in a savings account. Where I usually get involved and help people with is in this quadrant here, the accumulation quadrant, which generally consists of TFSAs, RSPs, and other maybe non-registered or corporate accounts where you're accumulating wealth to use at a later date, right? So in this setup, kind of step 2, which again is before step 3, is usually the emergency bucket, which generally is a TFSA, because a TFSA, if you take money out of it, it's non-taxable. So it serves really good as an emergency fund as opposed to an RSP. If you have an emergency and need it, it's taxable on top of what you've already earned that year. So the RSP and other more taxable accounts usually are the last and the very, at the end of this cascade where everything kind of funnels and all the surpluses kind of cascade their way to. So usually we're going to sneak or put retirement allowance into one of either the TFSA or the RSP, generally for somebody who has a simple setup, right? The main question is going to be, do I want to get taxed today or taxed later? And my conversation with this particular person, it was, we have to look at, do you have a TFSA? Is there a need in your planning for one? If you only have an RSP or only have a pension and some savings account, well, maybe we want to do a little bit of both. Maybe it's worth paying a little bit of tax today, to have that emergency amount. So maybe out of the 50,000, we pay tax on 10 or 20,000, depending on a tax bracket, etc. And then the rest we keep in, defer and put straight in the RSP without paying tax on it. And again, you need to have the RSP contribution room as well as the TFSA contribution room to do any of this. But generally, a lot of people do have these contribution rooms. So that's kind of on the way in. We kind of want to put the pieces together and see how that all fits. Now, when it comes to how are you actually going to use the money, I use kind of the same framework here. So when it comes time to retire, we kind of use the same three buckets, but instead of money cascading from your savings, from your income down towards into the buckets, we're kind of flipping a switch and pumping the money from the buckets to some form of utility, so towards your expenses and your lifestyle. So you're still going to need cash into retirement, usually for travel and short-term needs like winter tires or renovations or stuff like that, unexpected needs, washer, dryer, dishwasher, let's go, etc. And the TFSA is perfect to replenish that cash when it kind of depletes as you use it. So it's nice. The TFSA is perfect for that because you can go from your TFSA and top up your cash, and you can do that in bigger years where you're traveling more, you've had unexpected expenses, and it doesn't affect the taxable income you have for that year. as opposed to your RSP, for example, is taxable. And usually what you want to do is you want to fan that out over several years and only pay tax on what you need to pay tax on. So you want to keep within a certain threshold of taxable income. So usually the RSP, we pump straight towards your immediate needs, your monthly needs, and it replaces your income. It keeps the lights on, pays the groceries, etc. Versus the TFSA is a little bit more of this flexible play money that we spend. What you don't really want is, with poor planning, if you only have an RSP and never consider the TFSA, if you want to spend $20,000 on a trip, you may have to take $35,000, $40,000 out of an RSP because you have to pay tax on it up front in order to spend the 20 on whatever it is you need to spend money on, a new car or whatever. So at the end of the day, we need to look at, if you're in the accumulation phase or getting close to the retirement phase, which of these buckets are short, which are non-existent, and how do we want to use your lump sum, like at a retirement allocation? Where do we want to fit them in? Is it in the retirement bucket and we defer the tax as long as possible, or do we need to, or is the emergency bucket more important to your planning and where you're at, and it's worth paying the tax this year for whatever reason, and then it's tax free. You can use it and it's flexible. You don't have to worry about tax thereafter. So those are all considerations that you need, and this is kind of how I frame it for people so they understand why we're doing what we're doing. So it gives direction to, yes, we can run the math and all that stuff, but there needs to be logic in putting these pieces together and making the right decision so that it all fits towards a comprehensive plan that makes sense, that's understandable towards, the long-term goal of accumulating for retirement. So bottom line with this is you want to consider several factors. One, first and foremost, you need to consider their flexibility and your control on different options. What are the different outcomes with the different options at hand? So that is part emotional, part reality. It's a control thing, and that has to do with the individual and their faith and trust in whatever employer system that, or investment markets that are in place. So they have to assess the reality of their options based on, their values and what they believe in. After that, you can kind of look at the number. Then you have to consider the number, results, returns. A good advisor can do all of that. It's pretty basic math. And then you have to consider the taxes, right? So a good advisor will look at the tax situation, the inputs, the outputs, how much are you earning today versus what you'll be paying later, and also the big picture. You have to look at how all the pieces come together and fit into how you're going to use these things that you've accumulated over your career, right? So hopefully this situation helps people who are facing this decision in their career or near the end of their career. If you have any questions around lump sums, pension transfers, that is what I do. That's what I help people with. And hopefully this session was informational for you, and we'll catch you next time. Cheers.